Good evening, everybody. This is Professor Hassey, week 7 of our 10-week business finance experience begins. Tonight, we're going to be talking about finishing up the lecture and discussion to give you all the material you will need to do the California Best Trucks case, which was posted a week or so ago and which I asked you to review it last week. We're going to talk about that this evening. Again, that work is a paper and a spreadsheet analysis due the last Sunday of our term, August 16th. This week, we're going to talk about Chapter 12, Chapter 13, risk and return, more specifically, the definition of beta, and in Chapter 13, the definition and the calculation of weighted average cost of capital. You'll be doing the weighted average cost of capital, and in addition to a capital budget analysis, in your assignment number 3, which will be due next Monday, July 27th. That will all be in a spreadsheet format, that assignment. Assignment number 3 will be entirely spreadsheet format. So let's take a look, and I apologize again for last week. We had some computer issues here in the Claremont area. I did post a fairly brief lecture video. I hope you all had a chance to see that, where we reviewed the capital budget analysis and the steps involved in that. But here's where we are currently in this class. And so for some of you who have been away from us for a while, can maybe catch up. All your graded work is posted. All your assignments through assignment 2 is now posted. You might want to check your report card to take a look at your cumulative average up to this point in class, heading into assignment number 3, heading into the California Best Trucks case, and heading into our last work in regards to this class. So make sure you are familiar with your grades. If you have not posted or have some problems in the posting of your assignments or grades up to this point, please make sure you take care of that for in the next 3 weeks. This will go by very quickly and will be the end of our summer term. So make sure your grades are what you think they are. And if you have any issues on that, please let me know. Again, as I talked about last week, I created a California Best Trucks case file folder. This is where the case files are that you were to review. We'll talk a little bit more about that later. And again, I gave you a checklist of things you have to accomplish in order to do this case properly. Steps 1 through 7. You do that as your checklist, beginning probably in the next week or so. If not, you have already done so. And we'll talk about these steps tonight. We're going to be talking about the WACC calculation. And we'll be talking about that from Chapter 13. We've already talked about the net project cash flows, the return analysis, and we'll refresh our memories on that this evening. So again, that's your checklist to complete this analysis. A 2-file requirement posting on August 16th, APA paper file, and a spreadsheet analysis file. And every week from now on, we will talk about that and spend a little bit of time on that and go forward with that. So that's where we stand. Tonight, we are in week 7 file folder, risk, return, and the cost of capital. Hope you had a chance to see my introduction video. I look like I'm death warmed over in there. I don't know what the hell's going on there. But a couple of files for you to download and either follow along with me tonight or review after class. The solutions to week 5 capital budget analysis. This is that original capital budget analysis that we did a couple of weeks ago. This is your template for this analysis. And also our discussion tonight, where I'm going to have you, we're going to do another capital budget analysis. The second try through this. Again, week 5 and week 7 are templates for assignment number 3, which you'll be doing this week, and the California Best Trucks case spreadsheet analysis. So pay particular attention to these templates and when we review them and go through them this evening. They're determining the rate of the return on an investment in assets, determining A, what it cost us to borrow or issue the capital for that investment, and then a return analysis of the cash flows to determine is that investment recouping all of its costs. All right. So this is some of our information for tonight. So I hope you had a chance to look that over, and off we go to the races. First of all, let's talk about California trucks. Hope you had a chance to read it, but this is basically what it's all about. This is an assessment case for any finance student at the University of La Verne. They have to accomplish this, and let me explain that to you. One of the main reasons you pick University of La Verne, or you probably picked it for a variety of reasons, convenience. You maybe chose University of La Verne because some of your homeboys or homegirls told you it was a pretty good program. Another reason why you chose the University of La Verne is it fit into your cost or financial aid structure of how to pay for your education, which is a very important decision. And number 4, you picked it because hopefully we know what the hell we're doing. And one of the reasons why we know, or hopefully know, what the hell we're doing is because we are accredited by WASC, Western Association of something something. In other words, we are accredited. In other words, what we say we're going to do to give you a business administration degree or an MBA degree or a whatever degree, we do what we say we're going to do. So when you pay out the money to go to school here, or borrow the money, or have your employer pay for your education, we're going to accomplish what we set out to do to make the money that you're spending for this education of value. That's the bottom line. It's just like buying a car. It's just like buying groceries. You hopefully get value for your money, and the value that you receive here goes out many years. It develops your professional career. It develops you as a disciplined businesswoman and businessman. And even if you don't use these things in business, it helps you think. It helps you use skills of technology, critical thinking, reading and interpreting. Those skills will help you throughout your life. That's why you're willing to pay for your education today. So in order for us to get accredited from WASC, we have certain guidelines that we have to do. In other words, making sure we're teaching you what you should know to be competitive in the market. In this class, Business 330, the California Best Trucks case represents that assessment for accreditation. That's what that's for. Yes, the assignments, yes, the examinations, yes, the discussion post, yes, you showing up to class, yes, you following along what's going on is important. But as far as us proving to the accreditation body that we are doing what we say we're doing, and I am doing what I'm saying I'm doing, the California Best Trucks case is a assessment of that ability. If I don't do my job and you guys don't do well on this, all these file folders that you're submitting on this case are forwarded to the dean's office for review by the accreditation body. And if you don't do a very good job, they're going to say, maybe Rick Hassey shouldn't be teaching this Business 330 class, because you guys aren't coming out of this knowing what you should know. So these six questions right here on page 2 and 3, the basis for your paper. These 6 questions are proving to yourself, to me, to the accreditation body that you can study and interpret corporate finance. These 6 questions. Because they assess you on your ability to create a spreadsheet for the analysis and interpret that analysis to say what happened. And that's the nature of this case. The work we've been doing the last 2 weeks and completing tonight is taking this information in the exhibits and piecing them together into spreadsheet analysis to tell us and give us the data to answer those 6 questions. That's what you're doing here. And your job as a student is to interpret this data, put it into a spreadsheet format for an analytical analysis, and then explain what you interpret this information tells you. The net present value, the internal rate of return, the profitability index, the payback in years. Is this a viable investment for California trucks? That's what you're trying to answer. And in this analysis, you're comparing 2 products that California Best Trucks can to use. Should they build an engine called the Los Angeles engine in a bus, or should they build a bus with a California engine? Your job is to do the analysis for both products. 2 spreadsheets. One spreadsheet for the Los Angeles engine, one spreadsheet for the California engine. Taking these variables and determining. The biggest hassle is not taking this information and putting it into a spreadsheet. We're doing that. We've done that a couple weeks ago. We're doing it again tonight, and you're doing it in assignment number 3. The biggest hassle is to understand the data and what it's giving you. You know, one of the things, and I'm going to use an athletic connotation here. The other baseball is starting up this week. Matter of fact, the Dodgers are playing the Angels tonight. If you watch a Dodger game on TV, it's baseball. It's the same game as if they're playing the Los Angeles Angels. But if you watch the Dodger broadcast versus the Angel broadcast, it's like, in some respects, you're watching, is this the same game? Is this it? The Angel broadcasters versus the Dodger broadcasters, first of all, both of them are homers. Boy, I miss Vin Scully. Both of them are homers, but at the same time, they're doing the same game, but it's different. Your job as a viewer is to understand that. Well, in finance and doing business decisions, the data may look different for different situations, but basically it's the same game. But the data is given to you a little bit different, and you have to interpret that. It's just like you have to interpret, oh, I must be watching a Dodger broadcast, or I'm watching an Angel broadcast. They're the same game, but they're both explaining the game in their perspectives and interpretation. That's a pretty good analogy. I'm glad I'm recording this. It's the same thing here. You have to get used not only to the game, capital budget analysis, but how the game is given to you. Do you have the ability to decipher this? Because if any of you go on to MBA school, no matter where you go, you're going to be doing the same thing again in a different format. The game will be the same, but in MBA school, it's a little bit differently. If you go out and go to a company and they interview you and you say, oh, you like a job in our finance area? You want to work for the treasurer? Oh, tell us please explain to us, what is capital budget analysis? Oh, I got it. Capital budget analysis is taking an investment in year 0 and determining whether the return going out into the future years is exceeding the cost in the investment. Wow, you must have had HASI in finance. But then they give you the job. And the first week on the job, they say, okay, you told us you knew how to be, you're a HASI student, you know how to do capital budget analysis. Here's a capital budget analysis, do it. And it looks, wait a minute, this does not look like California Best Trucks. This looks a little different. Now you know why you have a business degree, because you'll be able to sort that out. You can think it out, knowing the type of game it is, even though the game is described to you a little bit differently. Welcome to the world of when you start making big money on a job and when you start not making big money. When you can interpret and critically think and analyze and interpret data, you're going to make more money. Welcome to the world. That's how it works in finance, even in marketing. If you know how the game is played and can play it and interpret it different ways, you're a valuable employee. Trust me. Trust me. And that's one of the reasons why you're taking this class in your business administration program. Not so I can bore you and drive you nuts with all these calculations, but so you can play the game of corporate finance and understand how to interpret it. Just like when you take a marketing class, an accounting class, an organizational management class, an IT class, an HR class, whatever. You're learning not only the cut and paste of the definition, but how to interpret it. That's a business degree. The only difference between that and an MBA or a master's degree is a master's degree, you come up with a strategy to play that game. That's the difference. That's the difference. So don't go ahead and waste $40,000 to get an MBA degree. It's not worth it. I probably shouldn't have said that because I have an MBA degree. But really, that's the difference. You are a strategist with an MBA degree. You're not with a business degree. That's the difference. Okay, so that's what we're trying to do here. Now, we're going to talk more about this next week. But here's a couple of key areas that you got to concentrate on if you've read through this before and say, I have no idea what the hell he's talking about. Here's one of them. We're told that this price that they're going to produce this bus, the differences between the two buses is one has a different engine. They're selling the bus in the market for $220,000. That's its selling price. They're producing 11,000 buses a year. Oof, that's a lot of money. 11,000 times 220,000. Woo. Open up those columns in those spreadsheets. The labor for each bus being produced is $50,000 a unit. The parts are $95,000 per unit. That's the variable cost. The fixed cost, or the selling and G&A, is $250 million a year. Now that's the same for each bus for the LA and the California engine. Then you have to add in, if you're doing the LA engine analysis, $25,000 a unit for the engine. So right now, if you're doing an LA engine analysis, 50, 145, $170,000 of variable cost. Labor, parts, and then the engine. And the fixed cost is $250,000. Excuse me, I wish, $250 million. And then it goes on in the problem to tell you that they're investing in year zero, $1 billion. Holy hoo. They're investing, that's year zero investment, $1 billion. That's the depreciable amount over 20 years. Straight line depreciation. Looks like, and the salvage value of $25 million is your salvage value in year 20. Now you can do the depreciation schedule. The working capital is 15% of sales. They have 2 additional expenses in years 1 and 2 for $100 million. After that, they're gone. It explains to that right here. But here's the hassle of the problem, and this is where critical thinking comes into play. Warren Buffett didn't become a billionaire because he's lazy. LeBron James isn't one of the best basketball players in the world because he doesn't practice. Really? He probably works hard more than anybody else. Messi in soccer. I don't know if you guys are football soccer fans. I am. Messi is not the best player in the world because he lays around all day and tries to hide his taxes. That's an internal joke. No, Messi practices harder than everybody else. You can't be lazy in any enterprise if you want to succeed. And in finance and in education, being lazy is not reading the problem carefully, not trying to understand what is asking you to do. And here's where students have a problem in this case. It's right here. The average warranty cost per bus is $1,000. The present value of this cost will be used as a cost figure for each bus. So in other words, when you sell this to a customer, you're giving them a warranty that lasts 5 years. So in year 1, if I'm selling a bus to somebody, it has a 5-year warranty. In year 20, when I'm selling a bus, it has a 5-year warranty. The company estimates to provide that warranty, they have to include an additional $1,000 a year for 5 years for the bus. And for the engine of LA, it's $500 a year for 5 years. For the California engine, it's $2,000 a year for 5 years. So that's $1,500 a year for 5 years, or $3,000 a year for 5 years of additional variable cost per unit. But here's the caveat. If any of you remember your accounting, one of the major principles of accounting is if you're keeping financial records, which we are doing a capital budget and an income statement as part of our cash flow determination in this project, if we're doing that, we have to follow what is called the matching principle. Revenues are matched with expenses per year. So if I'm producing a bus in 2021, okay, I'm selling it for $220. I'm selling 11,000 units. I got $170,000 of variable costs. I got $250 million of fixed costs. I got the depreciation expense, whatever that will be. And then I have this warranty. But the warranty is for 5 years going out. How do I match that expense of the warranty for the product produced in 2021? It tells you right here. The present value of this cost will be used as a cost figure for each bus. The present value of those costs will be the cost per year of the warranty. Your job and the assessment of this case is for you to work that out. How would you incorporate that into your analysis? That's what separates, to be perfectly honest with you, that's what separates the A's from the B's in this case. You to sort that out and figure it out. The second area of concern for you is the very first step. What is my weighted average cost of capital? We're going to discuss this evening, and we'll talk about this again next week. But this is the first task you have to do, is determine what is it costing us to get the $1 billion. And that's Exhibit 3. I strongly urge you, maybe not this week because you're going to be working on assignment number 3, but next week you have no graded work. Next week is the time to start putting these pieces together into this analysis. Follow those steps in the California Best Trucks case folder. I give you the chapters that they're associated with and the exhibits in the case. You should tick these off one after another. If you do that, you're going to be okay. That's the checklist. But your first task will be to determine the cost of capital, because I'm not going to give away any trade secrets. But once you determine WACC, that sets information available to answer other questions in this case. So there you go. Don't take this lightly. Oh, this is not due to August 15th. All right, I'm going to start putting this together on Saturday, August 15th. I'll just stay home all day and I'll crunch this out on Saturday, August 15th. And then I can hear my email or my cell phone ringing at 10 o'clock Saturday night. I have no idea what the hell I'm doing, Mr. Hassey. Can you help me? That's going to be a tough one. Start putting this together as soon as you can while it's fresh in your minds. If you wait and we go over other material in the coming weeks and you lose track of how to do this, it's going to make it very, very difficult. Okay. That's the California Best Trucks case. There's the checklist. Here are the files. If you have not read these yet, I strongly urge you to do so. Get a feel for what you have to do. And if you go to our week 7 file folder and look at very top of the file folder, week 7 in-class review. Here are the 2 templates to help you do that. Here are the 2 templates to help you do assignment number 3, which again will be another template to do the California Best Trucks case. You'll have 3 templates, 3 examples of how to do. That's where you can begin. So that's huge. Okay. And I'm not doing this to scare you. I'm doing this because if you want to get a business degree that's worth any salt, you got to be able to do this. It really helps you. And I know a lot of you are saying, hey, I'm going to be marketing. I'm going to be sales. I'm going to be HR. I will never have to do this. Really? If you become a department manager in HR, if you become a VP of marketing, and you're going to be sitting with the suits in a meeting and they're going to say, we're thinking about allocating some investment dollars into marketing. Here's a capital budget analysis. Could you please review this as department chair of this business, of this division? You got to know what's going on. You're not going to put it together, but you got to know what it's telling you. Trust me, that's going to happen too in your career. Okay. Well, wasn't that fun? To refresh your memory, here is that week number 5 spreadsheet. Where we determined this is the capital budget process. We only have to know the first 5 steps. We don't have to worry about this. If you go on to MBA school, you'll worry about that. Here's a calculation for the weighted average cost of capital, which we'll review a little bit again tonight. And here's that base analysis on an investment of $1 million over 10 years. And the return analysis in dollars, percent, ratio, and payback in years. This is that week 5 file that we looked at. And then tonight, we're going to look at this file. It's empty because we're going to put it together, you and me, with these inputs. This is a 4-year project. The last one was 10 years. The one you're doing in assignment 3 is 10 years. The one you're doing for California Best Trucks case is 20 years. We're going to calculate the WACC of this problem. And we're going to do this evening after our break at 7 o'clock. So this is a blank template that we're going to put together, and I'm going to post this when it's completed back to Blackboard so you have it. And then, as the last practice of all this capital budget nuttiness, in the assignments file folder, you don't see it now, but at 7 o'clock, you'll see assignment number 3. And that will be a file that you'll download and prepare in spreadsheet format, the capital budget analysis, just like we saw in week 5 and tonight in week 7. And that'll be your last practice of this prior to the California trucks case. So that's where we are. Okay. But before we do that, let's bring up the old whiteboard. An old friend. Tonight, as I said, we're concluding our work. We're concluding our work for this capital budget analysis steps and process. And our work is involved in determining risk and cost because they go hand in hand. What is it? We want to invest $1 billion in California Best Trucks to develop a new bus. We want to invest $1 million in an asset. We want to invest $340,000 in a new asset. How can we be assured, to the best of our ability, that that investment in those asset dollars is going to give us a return to pay back that money and give a return to our shareholders? That's the risk and the cost of a project, of an investment. A lot of students right now, especially freshman students who are in high school, and you guys might be doing the same thing for the fall, is deciding, is it worth the risk and cost to attend college this fall? And the people in University of La Verne's and universities all around the country are shaking in their boots. Is it your parents, your husbands, your children? Is it worth the risk for you to go to college in this pandemic environment? And is it worth that risk to pay the cost of attending? And what is the return? Well, you get a degree. But is that risk and cost viable? And us as an institution, I know Professor Hasse, I will not teach a class if I do not feel that the students are safe. It won't happen. They won't get me as a teacher. If I don't think the students are safe, and if I don't think I can provide value through online environment, I'm not going to teach it. And so those are decisions about right now that we have to make. And it's the same thing with major American companies. What should we invest in today to guarantee us, or hopefully guarantee us, a profit and return years down the line? And today we're making that investment decision in an environment where the economy is slowing down because of the COVID, and an environment of competition from China, India, Europe, South America. Can our product succeed in that competition? Is it worth the risk and the cost? Welcome to Business Management 101. And you guys are going to be in that environment when you graduate. You'll be working for companies that have to do with that. So this is an important facet of understanding business development. What is risk? The likelihood of success or failure. That's risk. And in chapter 12, it's one little word that defines that. Beta equals risk. Now, risk can be all different types of things. You can have an inflation risk, you can have an economy risk, you can have a COVID-19 risk. In finance, risk is defined as the beta. And the beta is a statistical Can't believe I spelled that right. A statistical analysis comparing, here we go, comparing a firm's return versus the market. That's what beta is. How do we compare to the averages of the market, right? We don't have to worry about in this class about how beta is calculated. We just have to know what it means and where do we use it in our analysis, okay? It's a statistical analysis comparing the return. What's definition of return? Profit divided by investment. It's the definition of our return versus the averages in the market. And if any of you are familiar or remember your statisticians days or statistics days, the variation or the deviation from that average, the greater the deviation, the higher the risk, the greater chance for error, failure. The tighter the data is to the averages, the less the risk. You're average. You're like everybody else. So there's less risk. Now you can put this in fancy Dan statistical calculation, standard deviation, regression analysis, make your head spin. We don't have to worry about that. We just have to know that if you have a beta of 0, you have no risk. If you have a beta of 1, you have average risk. That's the market. And if you have a beta of 6, you're Greece, the country of Greece. They have right now one of the highest betas. Why? Economy's not doing too good. Hasn't been doing very good for a while. Thanks to Germany and the Euros, they've been bailing them out. 0 risk, beta of 0. Average risk, beta of 1. 6.0, Greece. One of the reasons why in your last portfolio, I asked you to determine or look up the beta of your companies in your portfolio. That beta number is your company's specific statistical analysis compared to the market. Apple, 1.1. Disney, 1.2, whatever. 0.7. And you can compare that to the average in the market. Right now, in the world of finance, there's only 2 entities that have 0 risk. The USA and China. The United States government issued debt and securities have 0 beta. Why? They'll always be paid. Why? If we can't pay them, we'll just print more money. And we can get away with that because we have the world's largest economy. Secondly, China. Very close to catching up to us as far as economy is concerned. Their government debt and issues of securities has 0 risk. They can pay. Wait a minute, Mr. Hassey, how come Britain doesn't have 0 risk? If they can't pay their debt, they can print money. Yeah, but when they print money, just like Greece, they have high inflation. It's going to affect the value of their currencies. We've been borrowing trillions of dollars a year for 20 to 30 years, and our dollar is the strongest it's ever been. That's why we have 0 risk. Same thing with China. So 0 risk means you're either China or United States. And that's why when we see in our analysis in a little bit, the United States risk-free interest rate is the 10-year United States Treasury. That's the risk-free interest rate. The current yield of the 10-year United States Treasury issue is called the risk-free interest rate. Now, other people in other quarters sometimes use the 5-year, some use 20. The general feeling is the 10-year yield on the United States Treasury. That's the risk-free rate, zero risk. It's not very high. Right now, it's about 0.6%. 0.6%. That's not very high. Why? A lot of people are investing in United States securities for the safety. You're not going to lose any money, but you're not going to make much money. The average risk of 1 is the S&P 500, the average in the market, taking all the companies in the market and averaging them out 1.0. This is what Chapter 12 is all about. But all you have to know is, what is beta? It's a determination of risk. And you've just seen that in finding the beta for your portfolios. That gives you an indication of the return or the history of your specific company to the market. Now, the bad thing about it is beta is a historical number. It's not a future number. It's going back 4 or 5 years. It's not the future. So it's just like all statistics, it's telling you numbers in the past up to today. It gives you a stake in the ground of risk as of today, not tomorrow. Tomorrow your beta could change as the market changes. So that's an important characteristic to remember about risk. It changes all the time, usually every quarter. But for us today, it gives us a good starting point of determining the specific risk of any type of investment vehicle. And in the case of our study, beta helps us determine the cost of equity. The cost of equity. Remember, we have 2 costs when it comes to companies: the cost of equity and the cost of debt. Those 2 things, those make up what is called our capital structure. How do we get assets? We either borrow money, we issue stock, or we make a profit. Stock and profits are equity. Borrowing money is debt. To determine our cost of capital, we have to do an analysis before we can even do a cash flow analysis of an investment. Is we have to determine today, as of today, what is it costing us to get the money? And that's what Chapter 13 is about, how to come up with that calculation. Beta is a part of cost of equity. It's used in that analysis. Your beta tells you your risk in relationship to the market. If the market return is 7%, that means the market beta of that 7% is 1. If the risk-free rate return is 0.6%, that's the risk in the market of beta of 0. This changes daily, but it gives you a place to start of saying, okay, the market risk of 1 beta is 7%. The market risk of 0 beta, 0 risk, is 0.6. Our beta is 1.2. How does that equate to us, our cost? And that's the cost of equity. And it's talked about in a formula called the capital asset pricing model. You follow that model, you determine the cost of equity. Debt is a little simpler. Debt is simply the interest rate on your debt. Now, companies borrow different types of money, so that can be, you're going to have to average that out amongst all the debt borrowing you're doing. But we'll keep it simple in this class. We'll just pick one rate for a whole business. But at the same time, the interest rate on your debt is not the full picture of your cost of debt. Because why? interest is tax deductible. So we have to incorporate our tax rate to determine our overall cost of debt, because a part of our debt, interest, is deductible, lowering the true cost of that debt. After our break at 7 o'clock, we'll look at these two examples in a problem. But that's what it means. Chapter 13 is taking all of these, the cost of equity and the cost of debt, and putting them into a weighted average cost of capital. And it's the percentage of debt in the capital structure times the after tax cost of debt added to the weight of equity in your capital structure times the cost of equity. Add those two numbers together and you determine your weighted average cost. On average, this is what it's costing us to get the capital today. That's what that means. Want to impress somebody? Go up to your company treasurer or CFO and say, hey, dude, what's our WACC? Is it dropping or is it increasing? What's our WACC? They'll go, whoa, whoa. Where'd you come up with that? What do you mean by that? I just want to know, what's our risk in the market and how does that relate to our cost of money today in our business? Damn, you have HASI in finance. But that's a very important, when Donald Trump, every day of his presidency, yells at the Federal Reserve to keep interest rates down. When Donald Trump, and every day of his presidency, says, isn't the markets doing well? He's encouraging cheap weighted average cost of capital. Because the cheaper the cost of capital, the more valuable the assets that you're creating from that capital. I'll say that again. That's a biggie. The lower the cost of capital, the more valuable assets are. Your house is worth more money if you get a cheaper mortgage. Why? You're paying less leverage on that asset, and the asset can increase in value quicker because you have less debt against that asset. It's more valuable. What's one of the big moments in one's life? When you pay off your first installment debt. You make the final payment on your car. You make the final payment on your mortgage. What does that mean? You own the entire asset. Your value has increased. There's no longer debt taking away from that value. The same thing holds true while you're paying for it. The cheaper the interest, the more valuable the asset. That's one of the key requisites of Donald Trump's economic policy. Keep money cheap, because if money's cheap, the stock market will go up because companies' assets are more valuable and investors want a piece of that action. Welcome to the economy in the United States in 2020. And that's how it works. And the cost of capital is the key ingredient. Wow. Okay, let me save this. This is huge. So that's our reading for tonight. The definition of beta, and what is that cost of capital, and how is it made up? When we come back from our 7 o'clock break, we're going to look at a problem to work with these, just like what you're going to be doing in assignment 3, and just like what you're doing in the California Best Trucks case. So it's important. And again, the key to all this is to be able to take a snapshot of your business today and then use that information to project into the future. How can this money that I'm getting today equate to value and return in an asset in the future? You make that decision when you pick your college. You make that decision when you buy a new car. You make that decision when you buy a house. Is the cost worth the future potential return? You do that financially and psychologically. And if you can reason and understand the risk and calculate that and determine that it's going to prove profitable to you, keep on trucking and invest. If you feel scared, skittish about that risk, and you don't want to take that gamble of investing in an asset today, take a pass and wait for a different time period, a different economy, a different market. In the course of your lifetime, both professionally and personally, you'll be making these decisions over and over again because you're making a decision based on data today about the future going out X amount of years. Wow. When you take a new job in a company and you say, well, show me your retirement plans. You want to pick the best and most comfortable 401k plan that fits into what you can put in from your pay, what your company is going to put in to match it, and is it sufficient risk and no worries going out over the next 20 to 30 years? Because if you did that right and prudent, you're going to have a nice retirement fund when it comes time to use that. So this is how all this can relate to personal finance. And that's kind of cool. All right. We have saved that. That'll be posted. All right. Who fell asleep on me? Let's check this out. Oh, you guys are all chicken. You don't show me your cameras. All right. All right. There you are. Okay. Yeah. And now you show me. Okay. So let's take our 7 o'clock break. When we come back, thank you, Ashley. When we come back from break, we're going to take a look at a problem that talks about and reviews exactly what we just talked about the last hour. And we're going to do that in class. And you can do it, download the file and work with me, or just watch and then try to do the file after class, because you're going to have to do it anyways in assignment number 3. So that's the good thing about that. So now it's time to smoke them if you got them. Have a little beverage. Go wash your hands, and I'll see you guys back a little bit after, 10 minutes after the hour. 7:10. All right, guys, we'll see you then. Thank you. Okay, we have a little poll this evening, like we have been doing the last couple weeks. And our poll is for this week 7, cost of capital can be called the following, except which of these 5 does not represent the concept of cost of capital? Opportunity cost, hurdle rate, return on investment, weighted average cost of capital, or project risk? Which of these 5 does not represent the cost of capital? Different ways of saying it. You have 2 minutes. Okay, well, we finished. 19 of our 20 students this evening have answered. The question of our poll this evening is, cost of capital can be called the following except opportunity cost, hurdle rate, return on investment, weighted average cost of capital, and project risk. The correct answer is project risk. All the other 4 are different ways of saying the cost of capital. Project risk is the risk associated with a particular capital investment or project, but the risk has nothing to do with the cost of your money today in relationship to your capital structure and the risk in the market. Project risk is separate. It's a risk of the particular investment that you're making. For example, if somebody came up to Erica today and said, Erica, I got an investment for you. The investment is to give me $10,000, and we're going to invest that into an investment pool that's going to invest is going to hang on, now I'm getting the word except. What was this? I just saw a chat here. What's going on here? Hang on. The word except is no on the poll. The word except is not on the poll. Well, I saw cost of capital can be called the following, except maybe your screen cut it off. Sorry, Catherine, I don't know why that happened. Everybody else, does everybody see the word except?
Yes.
Okay, all right. Well, maybe it just happened on your screen, Catherine. Sorry about that. Okay, that happens. Sometimes our screens, especially if you're looking at on a tablet, or in some cases on a phone or something, it'll cut off certain things. So I'm not saying you did anything wrong, and not saying that no big deal. So I apologize if you didn't see all that. But the question of the what I'm referring to is there's different ways of saying cost of capital. You could say the opportunity cost. What is the opportunity of the cost of the project? A hurdle rate, that's the rate that if it's costing us a certain percentage, that's the amount of money we have to make more and above that hurdle rate. Return on investment. Our return on investment should be greater than that cost of capital. Weighted average cost of capital is also another way of saying cost of capital. Project risk is something a little bit different. Okay, so that was just our little funny thing. No grades, no nothing. It's just to change up our routine a little bit every week. So that's our poll for this week. Thank you for participating. Now, I'm bringing up week 7 capital budget analysis spreadsheet. Here it is right here for everybody to see. And first of all, it has 2 tabs. And I'm going to make this a little bit bigger for everybody to see it a little bit cleaner. There we go. The first tab we're going to concentrate on first, the computation of the weighted average cost of capital. This is a way of taking a snapshot now of the company and what it's costing them to get their money to invest. And we use this weighted average cost of capital number as our discount rate to do any present value calculations for a particular project we're looking at or investment. When I say project, I mean investment. So what is our cost of capital? First things you have to remember or have to follow is step number 1. What is the capital structure of the company? What is the mix of interest-bearing debt and equity? We don't care about accounts payable and short-term liabilities. We don't include that in this calculation. We just are concerned with what is the position of our interest-bearing debt. That could be bonds, it could be mortgages, it could be notes payable, and what position of equity, retained earnings, and stock of the company. And in this particular company, the capital structure is 60% debt, 40% equity. That's the capital structure. So now we're going to determine step 2. What is the cost of debt? What is the cost of equity? Based on the information given to us by this particular company. But again, our capital structure, which will be used to determine the weighted average of cost of capital, is 60% of the assets are funded by interest-bearing debt, 40% of the assets are funded by retained earnings and common stock issuance. So the company's tax rate is 25%. Their interest rate on this 60% is 9%. Their risk-free interest rate in the market with a beta of 0 is 2. The market return in the market with a beta of 1 is 10%. And the firm's beta for this particular firm is 1.35. Quite a bit north of 0 beta for risk-free rate and 10% beta of 1 for the market return. That tells you one thing right off the bat, that your cost of equity is going to be north of 10%. Because this is a beta of 1, this company has a beta of 1.35. So that gives you a clue that if you don't get 10% or higher for cost of equity, something's amiss. But first of all, let's determine the after-tax cost of equity. All right, the formula to determine that is just take the interest rate on the debt times 1 minus the tax rate. The interest rate on the debt times 1 minus the tax rate. In other words, we're paying 9% interest to our people who lend us the money. But we can deduct a percentage of that on our taxes. How much can we deduct is determined by our tax rate of 25%. So our interest rate after tax is equal to 0.09, 9%, times 1 minus 0.25, my tax rate. So in other words, 75% of 9% is my after-tax cost of debt. 6.75%. Yes, I'm paying 9% to my investors, my people who lent me the money. But I can deduct 25% on my taxes. So my true after-tax cost of debt is 6.75. So now I put this down here, 6.75%, and now I take 60% of that 6.75%, and there's my weighted average cost of debt. In other words, 60% of my capital structure is funded by debt. My after-tax cost of debt, as we calculated here, is 6.75. 60% of that, it's weighted in conjunction with my capital structure. Okay? I'm going to be giving you this file folder in Blackboard when we're done. Our cost of equity. And as I indicated in the beginning of class, the cost of equity is determined by what is called the capital asset pricing model. And that capital asset pricing model is this. The cost of equity, let's call it R, is equal to the risk-free rate plus what is called the market premium rate. And that market premium rate is multiplied times the beta of our specific company. That's the capital asset pricing model. The cost of equity is equal to the risk-free interest rate plus the market premium, with that market premium being multiplied times the beta of the company. So I probably should put this in a parentheses as well, because we're going to add that, add that to our risk-free rate. So this is one number here, market premium times beta plus the risk-free rate. Now, here's a little bit of a caveat. What is market premium? Market premium is the market return minus the risk-free rate. That's the market premium. It's the difference or the spread between the market return and the risk-free rate. That's called market premium. So if I give you the market premium rate, well, I've already done the calculation. But if I give you the market rate of return, you're going to have to determine the market premium by taking the market return minus the risk-free rate. They explain this to you in the text, but they do it very confusingly. So that's why I wanted to go over it here. That's the definition of market premium. So if we were going to write this out in English, risk-free rate equals, the rate of return or the cost of equity equals the risk-free rate, which is 2%, plus can't see anything, plus the market premium, which is 10%, the market return, minus the risk-free rate, 2%, and that's multiplied times 1.35. So we're going to determine the market premium by taking the market rate of return minus the risk-free rate. That's 8%. 8% times 1.35 plus 2%. So our cost of equity, or R, equals, now we're going to do this in math, equals 0.02 plus 0.08 times 1.35. Now we put that into a percentage. Go to the second decimal always, and we get 12.8%. That's our cost of equity. Thank you. Quite a bit north of 10%. The risk-free rate of 2 plus the market premium times the rate of the company. 8% times 1.35 plus 2 equals 12.8%. That's our cost of equity. Naturally, the higher the beta, the higher the risk, this number increases. The lower the beta, this number decreases. So we put down now this equity rate of 12.8%, and we take 40% of that to weight it to our capital structure makeup. So 40% of 12.8 is 5.12. And ladies and gentlemen, madame and messieurs, our cost of capital, our hurdle rate, our weighted average cost of capital is 9.7%. And that is also called our discount rate. It's our cost of money. As of today, not yesterday, not tomorrow, as of today, 9.7%. This is what chapter 13, basically 12 and 13 are all about, to come up with this number. And what it means for this particular company, the cost of their money based on the percent makeup of their capital structure in relationship to the market averages and returns and risk, it's costing them a little bit over 9% to get the money in relationship to their financial situation. Okay? And your goal as a CFO, your goal as a financial manager is to find the lowest possible number possible. The cheaper the rate, the greater the return, as we'll see in just a minute. So now I've done this. You're going to do this in assignment 3. You're going to do this in California Best Trucks case. The format and the numbers are given to you a little bit differently, and that's what I was talking about earlier. Your job as a finance student is to sort that out and fix it and put it in this format so you can get the bottom line. And the bottom line in WAC is 9.17%. So now we go over to this next analysis. And now we have an actual case where we're going to apply these numbers to. So let's put in our project WAC as 9.17%. There it is right there, That's what we calculated here. Okay. And now our task is, okay, our task is now, we plan on investing $340,000 into a new project. We plan through our accounting, marketing, manufacturing, we determine all these variables. Is it going to give cash flow? And is that net cash flow going to be greater than the net amount we're spending today in year zero? The definition of net cash flow is accounting income, revenues minus expenses, less taxes. There's our profit, net income. But then adding to it other cash-related variables that we will determine. Salvage value, depreciation, working capital. We did it in that week number 5 analysis. We're going to practice it here. You're going to practice it again in assignment 3, and then you'll be ready to tackle all that nonsense for the California Best Trucks case. So first of all, let's start at the top. What is our investment? Well, we're investing $340,000 minus $340,000. Boom. All right, that's our investment today. We're writing a check for $340,000. It's costing us 9.17% to get that money on average. I'll say that again. It's costing us 9.17% on average to get that 340K. That's our investment. Notice it went down here to net cash flow and calculated it as a total. Now, what's the next number? Salvage value. Year 4. So now they're telling us this only has a project life of 4 years. What is that? That's its depreciable life. You might own, I said this earlier a couple weeks ago, you might own this investment for 50 years. Its financial life is only its depreciable life. That's its financial life, 4 years. It has a salvage value in year 4 of $30,000. In other words, at the end of year 4, we're going to sell it and get $30,000 for it. We're going to depreciate, it looks like we're depreciating it straight line over 4 years, $85,000. So let's put that here, $85,000 depreciation. $85,000 every year per year. Okay? Notice I have formulas all set up to start doing the arithmetic. We'll worry about that later. Also, $85,000 is going to be added back in down here. Down here. Wait a minute, Mr. Hassey, you're subtracting it here and you're adding it back down here as part of net cash flow? Yes. Why? Depreciation is an operating expense. The IRS lets us depreciate as an operating expense, that as an expense of producing and running this project. But at the same time, are we writing a check to Mr. or Mrs. Depreciation? Are we spending cash to Mr. or Mrs. Depreciation? We are not. So the IRS, the tax people, give us the deduction here, and we add that deduction back after the bottom line as additional cash flow coming into the project because it's not a disbursement of cash. That's why depreciation is such a big number in finance. And that's why in accounting, it's a big number because you got to calculate that out so you can determine that in any financial analysis that you have to make. Now, wait a minute, before we move any further. First of all, we now know we're depreciating $85,000 a year. That's totals $340,000. So now we're saying we're getting salvage value of $30,000 in year 4 when the project is over. That, if you remember back to your accounting studies, is considered a gain on the disposal of the asset. Because it's a gain, we got to pay tax on it. These accountants, they drive me crazy. But we got to pay tax on that in year 4. We're now closing down the project. On our tax returns, we have to show we had a gain on the disposal of $30,000 because we fully depreciated the asset, and now we get a check for 30 grand. So we're going to have to change that and take out the tax equals 30,000 times 1 minus the tax rate of 0.25. So we have to take out 25% out of 30,000. So that leaves us with 75% after taxes, or $22,500. Be careful, I'll get you on that on any assignment or paper. Hint, hint. All right. If I fully depreciate the asset, I have to take tax out of the salvage as the gain. Don't forget that. Okay, now we're told that we're going to sell 2,000 units every year. That's our plan. Now they might sell more or less every year, but according to this analysis, we're going to average, and we're shooting for 2,000 units sold every year. And those 2,000 units are going to be sold at $1,200 a piece. So for year 1, why don't we put in equals 2,000 units times $1,200. Notice I put in the cells, because then I can go back in and change these cells and do different examples. So I'm taking $2,000 times 1,200. I get $2.4 million. But whoa, what else happened, Mr. Hassey? Well, remember right here it says annual change in sales price after year 1 is 3%. That's my inflation rate. I'm inflating that 3% every year. So notice in the next cell, I take this cell times 1.03, a 3% inflated amount. And that increases 3% a year. Even though you're going to sell 2,000 units every year, your revenue, or you might inflate the cost per unit because money is inflating. And so you have to inflate that number every year. Same thing holds true with your expenses, except for depreciation. Notice, look at here. Variable cost per unit is $900 a unit. Remember, variable costs are costs that stay the same as volume changes. In other words, it's going to be $900 a unit if I sell 1,200 or 10 million. It's still going to be $900 a unit. But naturally, the more I produce, the greater the expense. So now I'm going to take in this cell equals the number of units sold and produced, 2,000, times $900, my variable cost per unit. And boom, $1.8 million. And again, it's inflated at 3% a year. Now here's a very important tip. As you start getting into your spreadsheet, after you finish every line, hit save. There's nothing more frustrating as you start putting together these spreadsheets, and next thing you know, you hit the wrong key, or your dog Fido comes and steps on the keyboard, or something happens and you lose your data. Save it after every line. Trust me, that's a good tip. Now, the next question you might say is, Mr. Hassey, why do we even bother with the 3% inflation when it's 3% the same for selling, variable costs, and fixed costs? Why do we include that? Here's why. The capital budget analysis is not only a budget or plan of things happening in this project, it also becomes a budget or a way of measuring as the real numbers come in every year. You can do a variance analysis. After year one, did we sell $2.4 million? Was our variable cost $1.8 million? Was our fixed cost that amount? Depreciation probably is not going to change, but it becomes also a variance analysis document as the real numbers come in. And so you can compare the inflated amount. Did you gauge inflation correctly for these numbers? It gives you a testing point that the procedures that you do internally in your company, are they correct? Very important. Fixed cost, $400,000. Remember, fixed costs are costs that no matter you produce 1,200 units or 1 million units, it's still going to be 400,000. They do not change with output. So 400,000 here in year one, and that also is going to be inflated at 3%. Geez, Mr. Hassey, this is a nice template. I hope you keep this for me. It's all set up. It's doing all the math. Thank you. So look what happened. I had sales of 2.4 million. I had variable cost, fixed cost, and depreciation. My earnings before taxes was 115,000. Note the formula. Sales minus expenses. There's my earnings before taxes. My tax rate is 25%, so I take 25% of that number and I subtract it, and here's my net accounting profit. This is what I have to show the IRS. This is what I have to show on my income statement. I'm making a profit of total $372,000. But that's not what I care about for financial analysis, for capital budget analysis. I care about the cash flow. That's what I care about. How much actual cash are we generating? So now we have this net income number, and now we take into account, there's the salvage value, there's the depreciation being added back in, and the last analysis thing we have to do as far as cash flow is concerned, and it's already been automatically done for us, and I'll explain that to you, is working capital. 11% of next year's sales. Your working capital base should always be 11% of the next year's sales. And I think I explained working capital last time in this class. Working capital is the cash you have to expend to keep this asset operating. Receivables, inventory, working capital that you have to spend before you get reimbursed in the collection of your profits. And notice, in year 0, I take 11% of the first year's sales. So up front, I'm going to have to put up an additional $264,000 of cash as working capital, and it's based on a percent of the first year's sales. 11% right there, negative 264. So yes, I'm paying $340,000 for this asset, but my total cash outlay to get this sucker off the ground is $604,000. That's how much I have to recoup. And I think I indicated this a couple weeks ago. This is one of the major flaws of small business men and women. Oh, I know how much we need to get money to invest in our business, but they never think about the additional capital they got to put up front before they start selling and providing the services to get money or cash flow. They have to put up front money. And that's this indicator. This is balancing out the cash flow to make sure you're accounting for that extra cash you need. And then look what happens. Remember, 11% of the next year's sales. Well, the next year's sales in year 2 goes up by the inflation rate to $2.472 million. So I have to keep 11% of that base as well. So what do? I take the variance, the difference between year 2 sales and year 4, which just so happens to be $72,000, and I multiply that times 11%, and I get 7920. So now 11% of next year's sales is 264 plus 7920, or 271,920. That's 11% of 240.72. That's how that works. And that changes every year. The delta between the 2 years times 11%. So now we've accumulated through year 3 $288,480, which happens to be 11% of 260,22,545. Let me show you that. If I take this times 11%, I get 288,479, or 480 rounded. And that's how much I've accumulated up to this point in time. That's how that works out. But now year 4 is the end of the project. There is no year 5. So now the project financially is over. So now in the final year, I add back in all that working capital as positive cash flow, because why? The project is over. I assume now I have been fully reimbursed for all that cash I put up front, and the net effect on the project is 0. But I'm showing the cash going out and then the cash coming back in the final year of the project. Ladies and gentlemen, this is one of the reasons why our president, Donald Trump, became a very rich businessman. He purchased properties, invested in the properties, real estate, put money into them, took out working capital, but then his key ways of making money were to sell it at a profit at the end of the life, to sell those properties to some other people at a big profit, and to recoup the working capital. Then his huge cash flow received in the final year of his investment is going to generate enough return where he makes a lot of money. That's why you make money in real estate. And Donald Trump did that. That's why a lot of bankers gave him a lot of money, because they knew those costs or that money would be reimbursed to them by the end of the life of that project. This is how Donald Trump made his millions, billions, and how anybody in real estate does. Okay, we're done. We now have concluded this bottom line, net cash flow. So this project of a $604,000 investment today in year 0 is going to be generating net cash flow of almost $1 million, $999,000 into the future. Well, now we've done the first part of the analysis. Now we have to do the analytical or the return calculations. Is this enough to recoup our money? Well, we kind of know that $999,000 is a lot more than $604,000, so we are going to get our money back. But remember, this money is being received in the future. We want to compare it to today when we're making the investment. So that's why we're going to discount this $999,000 received in the next 4 years back at what? Our cost of capital, our discount rate, our weighted average cost of capital. So here's what I do. I want to determine discounted cash flow. What is this money worth today? Formula, function, financial, NPV, net present value. That calculation or that formula is going to take at 9.17%, there's our WACC as the interest rate, and then I'm going to take that future cash flow Year 1, 2, 3, and 4. There are my values. So now it's going to take year 1 through year 4 cash flow and discount it back at 9.17%. That's called my discounted cash flow. Boom. So that $999,000 is actually worth at 9%, 771, 707. My net present value is the difference. The difference between discounted cash flow and my investment. I'm making in total return dollars today discounted $167,774. That's my return in dollars discounted at my cost of money. What is this number in a percent? Formulas, function, financial, IRR, internal rate of return. And now all I have to do for the internal rate of return calculation is take the values not of only year 1, but include year 0. 1, 2, 3, 4. Take those 5 years, including the year 0, and what it's going to do, it's going to compare over time the investment versus the inflows, and I get 19.808%. That's my return in a percentage. Wow. It's the same calculation. It's just putting dollars into a percent. The profitability index is the relationship of net present value to the investment, the ratio. Net present value over the investment. So that will equal net present value divided by, and I'm going to put this as a negative, my investment, to turn that into a positive, 0.277. That's the ratio. Go to the nearest hundredth. .2 is my ratio. In other words, my net present value is 28% of my investment, 0.28. Profitability ratio. Profit versus investment. And my payback in years does not discount anything. It just takes how long until we get our $604,000 back. So in year 1, year 1, we have our investment plus our year 1 cash flow. So after year 1, we still have $440,000 to pay back. Year 2, 440,000 plus the year 2 cash flow. We still have $273,000 to pay back. Year 3, 273 plus year 3 cash flow. We still have $101,095 to pay back. So we now know that we're going to pay back the sucker sometimes during year 4. How much of year 4? All we do is take the percentage of this number to the year 4 cash flow. We get equals negative, because that's a negative number, divided by year 4 cash flow. Turn that into a percentage. One, 2, 3.24 years. 3.2. Let's make it 2. 3.2 years. Why? Because we're just going to take 20% of year 4 to pay back that 101,000. 1, 2, 3.2 years. You could be a little bit more specific, but I'll take 3.2. So What does all this has tell us? It tells us that this is a pretty good investment. In dollars, we're going to be getting 167,000 of discounted profit. We're going to make a return of about 19%, which is a lot higher than our 9% cost. We have a profitability index of 0.28, and we're going to get our money back in less than 4 years, 3.25 years. Maybe some companies want to make their money quicker. Sure, but we're going to get our money back. Discounted or not, we're going to get our money back. It seems like a pretty decent project. Ladies and gentlemen, as darkness comes on Claremont, California, and I have to turn on my lights. As darkness comes on in Claremont, California, we now have just completed for the second time a capital budget analysis. The difference between this one and week 5 is we calculated the WACC, chapters 12 and 13. Now we include that calculation in our analysis, and there we go. Remember I said earlier, if WACC gets cheaper, watch if I make this 7.17%. Let's say I find cheaper money and my WACC becomes 7.17%. Look what happens to my NPV. It goes up. Cheaper money. That's what our government keeps screaming at. Keep money cheap so companies can make more money. Cheaper money makes that happen. I'll put it back to the original amount. But that was my example of that earlier. Oops. There we go. This is chapters 8 through 13. This will be put back into the week 7 file folder, so you have this example, but I'm going to leave the original file there so you could try to do it by yourself, and fill in those blanks like I just did. See if you can do that on your own. But this is what we're doing, and this is what assignment 3 is all about. You're doing the exact same thing, but the years and the numbers have been changed to protect the innocent. But you're going to be doing the same thing into a spreadsheet file folder like this, and you'll be posting that spreadsheet. I do not want PDF versions of a spreadsheet copied into the PDF. I want to see your calculations, your formulas, your numbers in a spreadsheet. I've been too nice a guy too long. Week 7, we say spreadsheet or highway. That's an awful thing to say. Spreadsheet or no way. There you go. Got to do a spreadsheet, folks. Time to hit the real world. Okay, so if I go back to my Blackboard and I go to week 7, you will now have 2 files here, 3 files. Here's the week 5 one, where you didn't have to do WACC, but you had to do everything else. The week 7 one, which is the template with it blank, and now you'll see a third file in there called Solutions Week 7, with the file we just did with the WACC and the capital budget analysis calculated. And then now you go to your assignments file folder and magically appears capital budget analysis assignment number 3, where you're going to have to take this information and put it into a spreadsheet format to do those exact calculations that we just did, WACC and the capital budget analysis. Your job is to decipher that data, put it in that format, calculate the WACC, determine the return, and tell me yay or nay, is that project in assignment number 3 good or bad in your interpretation? All you have to do is put one word, yay or nay, underneath your analysis. But also even better now, you now have the basis of doing the case paper, California trucks. You now can do that. You now have all the data you can do with the data from the case to put that spreadsheet together, beginning whenever you choose to see fit. And I'll make a deal with you guys. If you put together your WAC for California Best Trucks, you can send it to me or email it to me or text it to me, and I'll tell you whether you're right or not. Okay? So the first thing you have to do with the California Best Trucks case is determine WAC. If you want to calculate that and then send it to me, hey, Mr. Hassey, am I on the right track? Did I do this right? I'll say yay or nay. Then you now can put together the spreadsheet. If it's nay, I might give you a little hint of how to clean that up. Okay? Now, I won't comment on your spreadsheet, but I will comment on your WAC because that gives you a good start. You'll need that WAC. Fair enough? Fair enough. Okay. Now, if you want to practice this work, if you want to practice this further, if you read in your introduction to week 7, I've given you a couple of problems, chapter 12, chapter 13. If you want to do those problems towards the end of the week, I will post the solutions to those problems if you want to check your work. These are further practice of what we did tonight. So if you want to do those sample problems, I will post the solutions to see if you did it right. And if you had a problem with that, we can talk about that in our office hours, or we can talk about those problems next week. But I probably would think you'd probably talk about it sooner because you have a case, an assignment due this week that these problems will help you with. But again, the information we already did tonight should give you significant template to do assignment 3 and the California trucks. But if you want to practice any more, here are some problems that you can do in practice, and I can provide you those solutions. All right. Tonight's the last night we talk about this. Next week, we go into the land of more different capital strategies and capital corporate finance. This is the last night of this analysis. But again, we will talk about and review certain aspects of California case, Best Trucks case every week. One week I'm going to talk about, well, one of the questions is you have to comment on the energy situation of this company. How are you going to do that? We'll talk about that. We'll talk about ways that you can format your paper to make it acceptable. We'll talk about other things. But this is the last night of talking about the actual capital budgeting, because you're going to practice it one more time with the assignment, and then you'll be ready. Wow. Next week, chapters 14 through 17. Did anybody look at the video of how the economic machine works? It's kind of a good video if any of you took the time to do that. Okay, there's that. All right. Anybody have any questions? Either you guys are so on top of this, it's not even funny, or your head is spinning and you don't even know what type of question you'll ask, or 3, I just want out of here, Mr. Hassey. 3 more weeks and we're done. I understand. Okay. Again, I have recorded this session because this might be a nice recording to go back to if you get stuck. You know, one of the nice things about these class recordings is you can skip through and you can find the sections that you're interested in and replay them, and there you go. So yeah, that's kind of a nice thing. Oh, by the way, I think a lot of you are beginning to think about your course schedules for this fall. I think you guys should plan on having them online. And maybe you've already been told that, but I think that's what's going to happen. And again, it goes back to risk and safety. I mean, I would love to teach you guys again in Burbank or Ontario or the high desert or Irvine or wherever. But it's too bad. We have to be careful. I mean, For a variety of reasons, we haven't taken care of this pandemic. And we are just around the corner, I think, from getting some vaccines, maybe at the first of the year. But until then, we have to be careful. And especially for a lot of you with children and elderly parents, some of them you might even live with your elderly parents, you don't want to mess with this. And I hope you understand that. And I hope you understand the university's position. It's to keep you safe. Now, it's our responsibility, the faculty and the staff, is to give you the best platform as possible. And that's where it requires your feedback. So one of the things, we've talked about in our professor interview that we had a few weeks back, but one of the things I need from you guys as we go out and conclude this course in a few weeks is feedback. Do your course evaluations. Let me know what are good and bad about this format. Good and bad for you. And that's important because yes, we have to be online, but this still can be a very valuable experience of learning if it's done correctly. So we need your feedback on that as we go forward. That's important. Okay, well, if there's no questions, I'm going to stick around for a couple of minutes. If any of you have any personal or one-on-one questions, I appreciate your this. I know this is an awful lot of material we've covered the last few weeks, and with me being away or down last week, that is an additional burden. But one of the things I'm going to be doing, and I might as well tell you this right now, is our work for this California Best Trucks case is due August 16th. I'm going to be having a review session for the California Best Trucks case on Saturday morning, August 8th on Zoom. In other words, August 8th is roughly 8 days before it's due. By then, you probably should have a pretty decent handle on the calculations and are probably getting ready to write the paper or have done so. That might be a good time to do one last questions or one last review of the case. And I'll send you the link to this special class. You don't have to attend, it's voluntary, but it's a special class on Saturday, August 8th in the morning. I will be recording it because it's a lot to ask some of you to take Saturdays out to look at my ugly mug. But I will record it, but it will be a special review session for the California Trucks case on Saturday, August 8th at 10 a.m. And I will send you that link probably next week. And guess what? It's free. I'm not charging you any extra money for that. Now, I will take donations of $100 or so. I'm teasing everybody. Don't listen to me. I'm being funny. All right. Carl, yes. Erica, question.
Will you take beer instead of $100?
No, I won't take anything. If you give me something, I'm going to throw it back in your face. So thank you. Carl, it's good seeing you tonight, buddy. Welcome back. I'm glad you're okay. God bless you. I'm glad you're feeling fine, Carl. What was that? And then we have Vince. Good to see you tonight. Glad you're here. And it's good to see everybody, even though I don't see you. Lupe, I'm sick of your dumb California LA Angel hat. You ought to get a new hat. By the way, speaking of the Angels, I think they're beating the Dodgers. I'm watching the game in the back.
We're losing.
Oh, the Dodgers are winning now?
Yeah.
All right. Sorry about that. All right. Okay, guys. Thanks, everybody. I'll see you all next week or in our office hours. And any questions, discussion board. Hi, Layla. Who's your friend? That's very nice. And I'll see you guys all next week. Oh, that's very nice. See you guys all next week. Adios.
Bye.
Hey, thank you.
See ya.
Bye. Thanks.
Bye-bye. Bye, Kathy. Bye, Miss Rubio. Goodbye, Ben. Goodbye, Vince. Good looking picture of you, Vince. Do you guys want to talk to me or can I sign off? 3, 2, 1. We're signing off. Adios, everybody. See you next week.